Okay, so trust. Who do we give it to? And more importantly, I guess, why? It's something we probably don't think about enough. But it's kind of the heart of what we're diving into today. We're talking FTX, cryptocurrency, a 2-year sentence that left a lot of people, well, scratching their heads. And to help us unpack all of it, I'm joined by, well, an expert who can separate, those splashy headlines from the stuff that actually
What I
matters.
think is so interesting about this whole FTX thing is that it really kind of exposes how even systems we think are, like ultra secure, can be vulnerable. And it shows how narratives, especially those around genius, can kind of obscure potential warning signs, right?
Yeah, absolutely. It's funny you should mention that. I was reading through some articles, and the name Caroline Ellison kept popping up. At first, I have to admit, I thought, okay, another, Wall Street type. But her story is anything but typical. I mean, we're talking Stanford math prodigy, daughter of an MIT professor. This is someone who, on paper, had every opportunity in traditional finance.
Yeah, and that's what makes her trajectory so unusual, even in the already like high stakes world of finance. To lead a hedge fund, especially so young, requires a certain appetite for risk, let's say.
Exactly. And it's not like she just stumbled into crypto, right? She dove headfirst into this notoriously volatile world and ended up CEO of Alameda Research, which, as I'm sure many of you know, was deeply intertwined with FTX. Now, I know not everyone listening is fluent in finance, so think of it like this. FTX, that was the massive online cryptocurrency exchange. Alameda was its trading arm, but imagine those arms are, a little too connected, sharing information, resources in ways that would make even someone who doesn't follow finance raise an eyebrow.
And they'd be right to raise an eyebrow. See, in traditional finance, this kind of close relationship exchange in a hedge fund, big no-no, strict regulations against it. It's like if the referee was also playing on one of the teams, just
Yeah.
undermines the whole idea of a fair game.
Right, right. Okay, so we have this, brilliant, ambitious CEO running a company that's playing fast and loose with the rules. And to make it even more interesting, she's romantically involved with the founder of FTX, Sam Bankman-Fried. Talk about a tangled web.
It's a classic story, right? Ambition, potential conflicts of interest, unchecked power, and all of it set against the world of cryptocurrency. But you know what makes it so compelling, so infuriating for a lot of people, is how quickly it all fell apart.
Exactly. And this wasn't just some small-time operation, right?
Hmm.
FTX was handling billions of dollars. And when the crypto market, well, took a downturn, let's just say it wasn't pretty for the thousands of people who had trusted them with, their savings.
It was a cascade of failures.
Yeah.
I mean, at its core, you have leverage trading using customer funds, which is inherently risky. But then layer on top of that the lack of real regulatory oversight. It's a recipe for, well, what happened?
And suddenly this story that had been kind of relegated to like the business section of the newspaper, front page news, everyone wanted answers. Who was going to be held accountable? And that's where Caroline Ellison's story takes a turn. And it's a term that sent shockwaves through this whole thing. She took a plea deal.
Yep.
Which, okay, I know what you're thinking. Plea deals. Pretty common in these big financial cases, right?
Right. But this one is different.
Different how?
The sheer scale of it. We're talking billions alleged fraud.
Yeah.
Then you have the sentence. 2 years. It sparked outrage. People are debating accountability, justice, the future of crypto regulation, really.
Yeah, 2 years for her part in this whole multi-billion-dollar collapse. I'll admit, even I was surprised. So what's the logic there? Is it just, making an example of someone?
No, it's more than that. Plea deals. They usually come down to cooperation. Ellison pleads guilty. She's their key witness now.
So she's giving them the inside scoop.
On FTX, Alameda, everything, it's invaluable to the prosecution.
The map to the treasure, so to speak, in exchange for a lighter sentence.
Right.
But even if she helps bring others down, does that solve the real problem? Shouldn't there have been, safeguards to prevent this whole thing in the first place?
That's the million-dollar question. Gets to the heart of crypto regulation.
Which, it's tricky, right? Because on one hand, it's this innovative tech, could revolutionize finance.
Absolutely. Decentralized, transparent.
Cutting out the middleman. I get the appeal.
But that decentralization, that lack of oversight, creates opportunities, too, for the wrong people.
Yeah.
And then, well, we see what happens.
FTX wasn't some algorithm gone rogue. This was deliberate misuse of customer funds on a huge scale.
Exactly. And that's where clear, enforceable regulation is critical, not to stifle innovation, but to protect investors, to protect the market itself.
Because stories like this, they hurt everyone. People start to question the whole crypto space. Is it legitimate? Is it viable?
Trust is fragile. in any financial system. Rebuilding it. It takes more than punishing a few individuals.
So it's not enough to just catch the people at the top.
Right.
We need to make sure they can't even climb that high again.
Exactly. We need more transparency, stricter requirements for these exchanges, better oversight to catch this kind of thing early on.
Which I imagine is easier said than done, especially with tech that moves so fast.
It's a challenge, no doubt, but one we can't ignore.
Because if we don't learn from this, history repeats itself. And it's usually the everyday investor who pays the price. It's easy to get lost in the weeds with this kind of thing, the regulations, the financial stuff. It's a lot. But at the end of the day, FTX, it reminds us that even with all the algorithms and blockchain and, well, human nature, still the biggest wild card.
Yeah, and it's interesting what this case shows about our relationship with genius, right? We're drawn to it, to people who seem to be operating on a whole other level.
Yeah.
But that fascination, it can make us blind to the risks, to ethical issues, even when there are warning signs.
We want to believe the myth, the infallible visionary, even when it comes to our money.
And that's the danger zone. Because when we put people or companies on a pedestal, we stop thinking critically. We become part of the problem.
Which is, not a great feeling. And it made me realize this applies to a lot of things, not just finance. Evaluating a business, scrolling on social media, even just choosing who we trust in our personal lives. We gravitate toward the shiny stories, easy answers, quick success.
And that's when we really need to step back. Hit pause, ask the hard questions. What's really going on here? Who benefits and how? Are we getting the whole story or just a polished version?
So it's not just about being skeptical or trusting. It's about being aware, seeing all sides.
Yes, and that takes effort. Finding different sources, listening to opinions we disagree with, being willing to admit when we were wrong.
We all have biases, blind spots. We all fall for a good story sometimes.
And that's how we learn, by messing up, by admitting we don't know everything. That's how we make better decisions, how we hold people accountable.
This deep dive, if anything, has been a lesson in that. Recognizing patterns, asking questions, remembering that people are behind all of this.
And as we look at the future, finance, tech, the systems we rely on, that awareness, that's what matters.
So next time you see a story, sounds too good to be true, remember Caroline Ellison, remember FTX, look beyond the headlines, ask the tough questions, and trust your gut, especially when something feels off.